Welcome back to the Global Ledger. I'm Justin. Stablecoins are almost always discussed in the wrong way. They're framed as a crypto innovation, a payment product, a speculative technology, or a threat to sovereign money. But none of those descriptions capture what stablecoins actually are. Stablecoins are not primarily about crypto. They are about funding, collateral, and par maintenance. And when you strip away the branding, the apps, and the ideology, you're left with something very familiar. Stablecoins are a modern form of shadow banking. And that's what we're going to talk about today. Let's get into it. At the most basic level, a stablecoin is a privately issued liability, denominated in dollars, backed by assets, and designed to trade at par. That should already sound familiar, because that's exactly how bank deposits, money market fund shares, commercial paper conduits, and repo funding vehicles have worked for decades. The difference is not economic, it's institutional. Stablecoins operate outside traditional bank charters, outside deposit insurance, and often outside consolidated supervision, which is precisely what defines shadow banking. Let's talk about par. Okay, the most important feature of any money-like instrument is par. A stablecoin only works if one token equals $1, always and without hesitation. But par is not guaranteed by code. Par is guaranteed by asset quality, liquidity, confidence, and credible backstops. History is very clear on this point. Anything that promises par without a lender of last resort eventually gets tested. Stablecoins, I don't think, are an exception. Stablecoins live or die by their collateral. We need to ask 3 questions when we're thinking about stablecoins, and that is, what backs the token? How liquid are those assets under stress? And who absorbs losses if prices move? Early stablecoins answered these poorly. More recent ones answer them better, but not perfectly. Treasuries, repos, cash equivalents, these look safe until, everyone wants out at once, which brings us back to the core issue. Stablecoins are not dangerous because they're digital. They're risky because they transform maturity and liquidity. Here's the key insight I think people overlook. Stablecoins are not just payment tools. They're funding instruments. They allow issuers to raise dollar funding, invest in short-term assets, earn a spread, and promise instant redemption. That is textbook shadow banking behavior. The system works beautifully in calm conditions, and it becomes fragile under stress. And not because anyone did anything wrong, but because par maintenance is hard without a backstop. Why did stablecoins grow so fast? Here's what I think. Stablecoins filled real gaps. Faster settlement, global dollar access, 24/7 markets, fewer intermediaries. They succeeded not because regulation failed, but because existing systems were slow, fragmented, and expensive. Stablecoins didn't break the system, they exploited its friction, which is exactly how shadow banking always emerges. Let's talk about the regulatory tension. Here's the uncomfortable policy problem, okay? If regulators ignore stablecoins, risk grows unchecked. Okay, if they regulate them like banks, innovation starts to slow. If you ban them completely, activity moves offshore. There really isn't a clean solution, which is why the debate keeps circling. Should stablecoin issuers hold bank charters? Should reserves sit at a central bank? Should redemption be limited in stress? Every answer reshapes the system. Let's talk about stablecoins versus CBDCs. Let's connect it back to our last episode, okay? CBDCs represent cautious institutional change, slow-moving, stability-first design. Stablecoins represent fast, market-driven innovation, liquidity-first design, and risk pushed to the edges. They are not opposites. They are responses to the same problem, which is the need for better dollar mobility. One is public, one is private, but both reshape the future of money. And this matters systemically. Okay, stablecoins force us to confront a truth. The global dollar system is no longer confined to banks. Dollar liabilities now exist on balance sheets and funds and repos and clearinghouses and on digital ledgers. The question is not whether stablecoins belong. The question is how much instability the system is willing to tolerate in exchange for speed and access. Thank you for listening to episode 86 of The Global Ledger. We talked about stablecoins and connected them back up with CBDCs. We talked about what stablecoins do, what are their risks, and just what they are in general. In the next episode, we're going to be talking about something that's definitely a hot topic, and that is artificial intelligence, AI, and markets. That's next. Once again, I'm Justin, and thank you for being here.